Welcome back to our channel, Market Forecast and Investment. So here, traders and investors, let's make a quick recap of our discussion for the previous videos we shared to you. So here, we presented and we have explained the basic theory of the Elliot wave principle. It is noted that the first major wave will always be composed of 5 waves. Wave 1, corrective wave 2, third impulsive wave 3, corrective wave 4, and lastly the fifth impulsive wave 5. And after the first motive phase, market will undergo a corrective phase, which is composed of an impulsive wave A, corrective wave B, and then another impulsive wave C. And this whole market is already comprised with a major wave 1, which is the motive phase, and the corrective phase, which is a part of the bigger wave 2, and the trend continues, the market cycles. Another thing that we have discussed before is how do we actually trade. In these videos we already discussed that there are options in entering the trades. One is on our aggressive entry, which means that the price anticipation of its final correction, which will be on the most significant Fibonacci levels 236 and 382. The price settled on these levels and the price undergoes a sideways correction, so that will be our conservative entry. Then the lastly is known as the breakout. When the price eventually break this last highest point of the first impulsive wave, the next entry will be the retest of this. As you can see, I made this lecture and educational video on one of the hot stock in our market today that was started last year, December. So enough of that. What I will be sharing to you, the continuation of our topic, how do market makers execute our trade. So please bear with me as later on we'll be sharing you some of the tips and slight information or the combined ideas I have accumulated over the past 2 years. Firstly, I will be sharing guide to trading Fibonacci trading. Next one, how gaps reveals hidden orders and how will we utilize scenarios in our trades. One by one we will answer these topics. So before, I have shared to you how do we trade waves using the Fibonacci trading. So Fibonacci is a method wherein when there will be a price impulsions, we will always look for the retracements which are noticeable using the Fibonacci retracement toolbar. So in this topic, which I was shared before, after an immediate impulse wave in the market, in whichever time frame you have, entry recommendation is after the correction, which will be on this side. So in this area, some candles are forming bearish bar. So when you see a red candle, a bearish candle heading to our area of interest, we always look for the candle which are diminishing and decreasing. So in this area, price is still not yet final and not yet revealed its completion. So we always wait for this level to be tested, and once we observe that the price made something like this, a wick or somewhat a doji, meaning to say the price have indecision on this level, so the price more likely have respected this Fibonacci level. This will be our we have to wait to reveal the nature of the investors and buyers and sellers. So in this level, the buyers and sellers are fighting. If the buyers will successfully held this level, it will actually make some aggression. So after that aggression, market will retest this level, and if it's confirmed that this level is held by the buyers, eventually spec the level, and then the market will resume and reverse to its previously maintained impulsive wave. So this is an example that the level is held, but what happens if this level will be invalidated? The next thing might happen is it will break down, it will make a retest, and then it will continue going down. So these are the two possible scenarios that will be expecting on these levels. So if we trading using Fibonacci levels, we will only wait for the level to be, and if we have a aggressive option of entry, we plot for the next lower Fibonacci level, and if we made an entry here, our immediate stop loss will be on the next Fibonacci retracement. The target is either the last high, or if you are a long-term investor, so you aim for this golden ratio right here. So this, the retracement is 382, so your target is on these areas. So that's a rewarding trade with a very tight stop loss. So next question is, how do gaps reveals hidden orders? So let me tackle with LTG. I have made analysis about this. So I want to make a video with at least 15 minutes, since I have to make it as shorter as possible, but the discussion is a little bit husky right now. So here, this is an actual chart of LT Group Incorporated. So this one we will feature this chart also for now. So here we have a very nice uptrend right here. Suddenly it was corrected, and we don't know the market last direction or completion, but since we have these labels, so we are certain that the market will be heading for its completion of the corrective wave. So how do we use the gaps? The gaps, as I have mentioned, these are unserved orders or unmitigated blocks, wherein the buyers were left because of the momentum of the market sentiment. So all of the orders right here, so we shift to daily time frame, all the orders here were left. All who tried to buy on this area were left because of this price gap up on this this time horizon. So if some place orders here with a volume, basically these orders were not filled, but rather the market went directly to its trend and eventually left these orders. So what happened actually to these orders? These orders, the market has a way of its rebalancing. In the near future, the price will tend to fill these gaps and satisfy this the buy volume here, which if we check our market, the price is actually will be heading on this area. Technically, the price is still on its wave Z, the last wave of a very complex correction. So let's shift to weekly so that we can have a larger view of our chart. So if we shift zoom, actually we have made an erratic and very in-depth analysis, so we only focus on this part. So right here we will anticipate that the price will make a retest on this area of interest, so this will be our buy recommendation at 8 pesos, and our stop loss will be on this last low of the week in last August, actually a month wherein investors are freeing the market and in respect with their belief that it's a ghost month. So it will repeat itself, history will repeat itself. So we're heading for this August month. More likely the market will try to show this weakness, and then let's be prepared and grab this opportunity. The chart is presented to you, and this buying opportunity is also at hand. So be ready for this opportunity for the coming. And then lastly, our last question. So why do we actually say that the market is somebody made the market? Um, the market is just composed of the prices, structurals. So it doesn't actually is controlled by anybody or anything else. But when it comes to our market, since we have a very low and our market is still emerging, so anybody who have the capital which can move the market, so it's actually it's their volume of orders that will actually make some impact on the prices and the markets. And actually they don't just made the entry on the market without without basically following some of its principles. So I believe that this Elliott wave theory and principle is highly respected, especially for this type of market, and that Elliott wave follows these Fibonacci levels, which is generally the market psychology of how the traders, the combination of the traders, these investors, that is also the participants of the market in the market. So in this level, on these areas, may you learn something, and that these inputs which I shared to you will be utilized on your own perspective, stuck on your watch list. And thank you for your support, and we'll see you in the next video. If you feel value and you valued our contents, feel free to like, share, and subscribe to our channel to keep us motivated to share to you. And we will be trying to make a good content as our topics becomes complicated for you now. Have a nice week and see you.